Yeah, everything's good. I can hear you.
I don't know how to get to my thing so I can change some things.
Oh, you want to get off of here real quick?
Yeah.
Okay, I need to stop sharing.
Okay.
Okay, now you can change things.
Well, not in here. I want to change it in
Oh.
Zoom and making sure my background. But you could hear me?
I can hear you. I see you with your background. This is a separate screen.
Okay. So that's the main screen though, right?
Yeah. If you do want to come look at my my computer so you can see what it looks like for you. And then to move, you just
Yeah, those. I
Those
saw
two.
that. And it's also down there. So
Oh, I
that'll
need
be
to-
on the screen. I'll be talking.
let's change your name. Okay, so here you are right now.
Are we on shared?
Yeah.
Okay,
We're
so
sharing screen. Do you want to look at my computer right now, or me take a picture of it so you see what you look like on their screen?
Yeah.
Okay.
yeah.
I'm gonna text it.
Can they hear me right now? While
Yeah.
we're talking? Yeah. No.
No,
Is it? I didn't want to.
you don't have any writing or any brochure?
I do. Are
Can I
you?
check them? Or
Yeah.
you need it?
No, because I've got it hooked up there, so that's fine.
Thank you. Thank you, Lester.
You're welcome.
Bye.
Hi.
Hello, how are you, Farah?
I'm fine. Can you see me? No.
I can't. You've got just a blacked out screen for me. I can see your name.
You can see who?
I can see your name.
Oh, okay. Let me see what I should do.
All right, it's almost 11 o'clock. Let a few more people come in.
Hola, Chris. How are you?
I am good. How about yourself?
Been good. What you been up to?
Oh, just trying to stay safe, uh, working my tail off. It's been quite a run the last, God, 2 years.
Yeah,
But yeah, good. How about yourself?
doing good. Saw your postings of you in the pool with the kiddos and friends and family.
Yeah, that was
That's cool.
That was really a fun trip. My older set of kids, we have four that are in their 20s, so it's really cool to be able to see them grow, and now they're adults and they've got significant others, and being able to spend time with them and
Wow.
really just kind of enjoy them and get to know their significant others. But it was just a great week. It really was.
Yeah. Yeah,
Relaxed.
it is. It is good. Yeah, it looked like a lot of fun.
It was. It was. As the family grows.
Yeah, yeah. And then also they change. Their
Yes.
perspectives change, their habits change.
Exactly. Exactly. All righty. Well, it is now 11 o'clock, so I will go ahead and start. I put this out here because I get a lot of calls all the time, just asking me really basic questions about, financing and, is this legitimate? Should this lender be asking me these questions? How come they're asking all this documentation? What is it for? That kind of thing. So I thought I would just go back to basics and let people understand what we're trying to do on the front end so that the back end runs a lot smoother. This is going to be the first of 4 series training. So this is really going to give you more of a basics of financing, what we're trying to do on the front end. But then later on, we're going to have ones for FHA and VA. There's a lot of low down payment programs now for the higher end, for the jumbo sector. That'll be another class, as well as then down payment assistance. So let's kind of dive right into financing 101. Why should you care about all this stuff? I mean, you guys are on the other end of the fence where you're handling buyers, but you're not really handling the finance. You're doing more of the real estate, the showing of the properties, the listing, that sort of thing. But you guys get asked a lot of questions. Why are they asking me this documentation? How come they're scrutinizing everything that is on the documentation? So that's why I kind of want to have this class so that you can, know why we're asking this stuff. So let's go to the first page. This is kind of the topics we're going to talk about: pre-qual, pre-approval. What's the difference, and why does that matter to you? The documentation checklist, credit report, income documentation, and then asset documentation. So the first thing is just a pre-qual, pre-approval. Be very leery of any documentation that you get that says they're pre-qualified instead of pre-approved. There is a big difference. Pre-qualification just means that they've talked to a lender and verbally given the lender some information in terms of what they make, what their debt load might be, how much money they have in the bank. They might not even have pulled a credit report. They just told them, hey, on Credit Karma, my FICO score is 740. I make $10,000 a month and I've got $60,000 in the bank. What can I qualify for? Well, we can tell someone just based on that scenario what they're going to qualify for. That's just pre-qualifying. That doesn't mean that they're actually approvable for that because we haven't checked their credit. We haven't looked at their income documentation, make sure that is in fact what they make and that the money is legitimate in the bank. A lot of people will tell me that they make, $120,000 a year. Well, that's the possibility of 120, but their base is really 100 grand with bonuses, and they just got promoted to management. And so all of a sudden, I can't use that bonus structure because they don't have a history of it. And all we can really use is their base income. So now their qualifying is a little bit lower. That's because the pre-qualification was just verbal information, where the pre-approval is actually where we took a look at all the information. So let's go to see the documentation checklist of what we want so that we can move them to pre-approval. It's really just your basic documentation. All lenders are going to require the same documentation. This is just the start. This is just generic documentation that we're going to get. From here, we might need more information based on what we see from the documentation that comes in. So we're going to ask them for the last 2 pay stubs. We're going to ask them for the last 2 years W-2s, the last 2 years of tax returns, and the last 2 months of bank statements. Now, there's a reason for all of this. A lot of people don't want to give this documentation up front because they feel like, why should I need to? I'm great. I've been working at my job for 5 years. I've got the money in the bank and I know I qualify. Well, the problem is a lot of the documentation will have issues with it. And we want to be able to comb through those issues so that when you write the offer, you know for certain that the property is going to close because the client's going to be able to get that loan. Versus if you just throw it in there because they said they're approvable, and all of a sudden the documentation is a little bit different. So the pay stubs, we want to see what their current earnings are. What are they doing in terms of, are they hourly? Are they on salary? Is it on pace for year to date? Because a lot of times people are only working 36 or 38 hours a week. They tell you an hourly wage, and when you get their pay stub, it's a little bit different. So the pay stub is important to see what they're doing currently. We want W-2s to see if they're on pace to earn what they did in 2020, 2019, because lenders really look at a 2-year average on someone's income. We're going to give them their base salary or their full-time hourly income. Plus, we're going to average any overtime that they've earned over the last 2 years, any bonuses they've earned for the last 2 years, any commissions they've earned over the last 2 years. We're always going to average that. So we're going to start with their base, and then we're going to add on to whatever bonus or commission or overtime, and we're going to average that over the last 2 years. In addition to that, we want to see year to date is matching what we're using for bonuses and commissions and overtime. So if someone worked a lot of overtime over the last 2 years and they were getting, let's say, $500 a month in overtime, well, here we are in September now. So we've already had 8 months of 2021. So they should show on their pay stub over $4,000 year to date for overtime. And if it's not, then the question is, how come it's decreased? You've averaged over the last 2 years, $500 a month in overtime. So you should be on pace to earn another $6,000 for the year. So it's one of those things where we just want to see what you've done over the last 2 years, what you're currently earning, and what we can actually use for the bonus commissions and overtime. Also up front, I want to say, take a look at tax returns. And that's important too, because sometimes people disclose second jobs they may have or self-employed businesses they have, but they're on their tax returns. And the problem is you get blindsided once you get into escrow because you didn't really look at their tax returns before they got into escrow. All of a sudden you look at their tax returns and they have this small side job that they have had for the last 2 years or 3 years plus, and it's actually showing a negative cash flow. Well, all of a sudden the underwriter is calling for the tax returns. You put them in the file and they've got this separate self-employed income, and it's a negative number. Now all of a sudden it's going to hurt your qualifying ratios. So that's why it's important to see on tax returns up front so we can make sure that there's no issues with them, so that would blindside us later on down the line. And in terms of the bank statements, we're going to get the last 2 months because we want to take a look at and see what kind of deposits are actually coming into their bank account. Is there any outgoings that we need to be aware of? Like there could be child support, alimony. We don't really ask that question on a application anymore. So we're not asking them if they're obligated to pay child support or alimony, but it's something that they may be paying. And you're going to see that on a bank statement. And all of a sudden now, if the underwriter sees it, they're going to question it, ask for the divorce decree. Now all of a sudden you've got another debt that you've got to be concerned about. And because you didn't ask the client, you get blindsided because it's on the bank statement. So those are the reasons why we want all the documentation up front. From that documentation, it could lead to other documentation we need, but this is going to be your basic documentation. All right, so let's go into the first biggest thing that we're looking for when we get into kind of the pre-approval process. It's really to pull a credit report. Take a look at the credit report, see what's on it. It's really important to take a look at it because it's going to affect so many things. That FICO score is going to govern what interest rate they get. It's also going to govern what kind of PMI payment they may have if they're putting less than 20% down. So it's really important for us to take a look at that. Not just what debt load's there, because you need that debt load to calculate a true debt to income ratio, but it's really so that we can price it out accordingly based on their FICO score. We can give them an accurate quote, not only on interest rate, but for PMI as well. So it's really important for us to go ahead and pull that up front and then ask questions. Look to see if there's any inquiries. Are there any other things that show up on their credit report? Maybe there's some liens that show up there, or judgments, charge-offs, that sort of thing. It's also where we can see if there's any prior bankruptcies or foreclosures that we should ask the client about, so that we're properly getting the information from the client so that there's no hiccups once you get into escrow. Now, so going back to the FICO score and interest rates. Now, most people don't realize that, but there's mandatory FICO hits based on your FICO score. So it's not just the loan to value or down payment that someone may be putting out there, but it's also looking at, because of this FICO score, there's an add-on of maybe 0.5 point in fee to that rate, or 1.25 points in fee added to that rate. So it's really important to look at the FICO score. And maybe there's some things that we can do to improve their FICO score. Maybe it's just simple paying down of credit cards, because they hold a couple credit cards and they don't really distribute all of their credit evenly over the credit cards. They put it on 1 or 2 cards. So those credit cards are maxed out. Now, when we look at someone's FICO score, one of the biggest things we can do to help someone's FICO score is to look at the proportion of balance to limit. And what that means is, when we look at what the limit is, let's say it's a $1,000 limit. Well, if a person has a $900 balance on that $1,000 limit credit card, they're at 90% of their limit. That's considered in the FICO model a high credit user. Because they're considered a high credit user, they're going to have a lower FICO score, versus that same person, the same income, same bank information, has a $10,000 credit limit and a $900 balance. They still owe the same amount of money, but you can see that the person with a $10,000 limit only has a 9% usage on their card, which means they're going to get a better FICO score. So that percentage really matters. So when we look at it, what I'm trying to do is tell people, go ahead and pay down those credit cards. We can run what is called a what if simulator in the credit agencies to find out what we can do, and at least advise our clients within a certain 5% up or down. If you do this to your credit cards, we could see a 25 bump in your FICO score. So instead of being at 675, we can get you over 700. Now, pricing's different, PMI is different. All of that's different just simply because you paid down your credit card, or increased your credit line. I've had clients do that too, where they just call the credit agency and see if they can increase their limit from $1,000 to maybe $10,000. That will instantly help their credit as well. So those are the things that we're looking at. We're also looking to see if there's any erroneous marks. Sometimes people don't know what's on their credit. So it's really important for us to pull it up front, not just for pricing and to help them to see if there's something they can do to improve it, but also maybe there's something that shouldn't be there. Maybe there's erroneous reporting on something because they were like an authorized user on an account, but that wasn't really their card. Well, we can help to try to get them to get that off and overall improve their credit, to improve their score, because again, credit scores are very important. So that's what we're trying to do right up front, is to take a look at their credit, kind of analyze it, and then based on that, go ahead and give out an accurate quote for not just interest rate, but for PMI, and then of course the overall monthly payment. All right, so let's look at income. Now, the first thing is, we say DTI all the time. People always stop me, well, what does that mean? That's just debt to income ratio. That's all it is. So we're looking at DTI. Now, there's two things we're looking for when we talk about debt to income ratio. And how we get to the debt to income ratio is, first we have to decide what is their qualifying income. That's based off their pay stubs, W-2s. It could be someone who's self-employed. We're going to look at their tax returns, analyze it for the last 2 years, determine what their gross monthly income is for qualifying. And then it's just simply looking at their gross income, pitted against what the mortgage payment is, and that will give you a DTI, which is called the front end. And then there's a second one that everyone looks at, and that's called the back end. That's going to be not just the mortgage payment, but it's also going to be the monthly debt load that they have, which is any car payments, any student loans they might have, credit cards, that sort of obligation, or maybe some other rental properties that we have to take into account as well. So it's not just the mortgage that they're qualifying for, but it's also what debt load they have. And that's what we call the back end debt income ratio. You probably hear us say it all the time. Yeah, the max DTI on this is 43 or 47 or 50 or something like that. But that's what that means, is we're looking at what is their qualifying income, and we will base it on a certain percentage. That is the max that they can then qualify for. So when it comes to income, again, what we're doing on a W-2 employee, we're just getting their verification of employment from their employer with the pay stubs, with the tax returns, W-2s. We're looking at it and making sure that they do in fact have the qualifying income for what they're trying to get qualified for. Again, kind of going back in there, we're going to average overtime bonuses and commission. So once we get that verification of employment, what we call a VOE, once we get that VOE back from their employer, it spells it all out for us. Some of this stuff comes back within minutes because it's all electronic now. So we can just punch it into the database, and it just gives us the information really quick. So we can see what their base income is, and then we're going to see it broken down. What did they earn in 19 for bonus, commission, overtime? What did they earn in 2020? Bonus, commission, overtime, and then year to date. And again, year to date has to match what we're going to give them when we look at their average. So that's why it's important to get all this documentation up front. We want to see everything for them to be qualified correctly. In that, when we're qualifying, we're also having the conversation with clients that possibly they want to pay off debt, or not just pay it down to improve credit score, but maybe they pay off a credit card or a car loan or something like that. So it helps them qualify for more of a home loan. All right, so that's income. Next thing is going to be the asset portion of it. All right, this is really important. And not just credit, income is important, but assets important because we need to make sure that the client has all of the necessary funds to close the transaction. Now, a lot of people just look at, hey, I got $20,000. I got the 5%, I'm good. Well, not necessarily. It depends on what type of loan program you're going after, because sometimes you need to have reserves. Who's going to pay the closing costs? So it's not just down payment, it's also closing costs. And you need to know all this, because when you write your offer to the seller, you may have to ask for certain closing costs to be paid by the seller. Although I think in today's market, it's going to be hard pressed to get anything like that, or at least not initially. You probably get it after you do the home inspection and you find out that there's a lot of repairs. And once you do the seller request for repairs, after that, then instead of them doing the repairs, you get the credit at that point, right? So in the assets, what we're looking at is, when I look at the bank statements, I want to see what their deposits are. If it's coming from a legitimate source, we're okay with it. We can see the wire coming in from their employer. We know that that's their payroll income. That's fine. We're going to go ahead and give that to them, and we're not going to ask any questions because, well, it matches the pay stub, right? But we're looking for other deposits. So the thing is, now this is kind of old. FHA wants $1,000. I put that there, but really now it's more of 25 or 50% of the monthly income. So what I mean by that is, let's say that they had a monthly qualifying income of $10,000. Now, for just your normal conforming high balance loan, or even just normal conforming for that matter, it's 50% of whatever your monthly income is. So if your monthly income is $10,000 a month, that's a $5,000 deposit. If it's less than that, we're not going to ask any questions. You're fine. That's okay. But if it's larger than that, now we have to source it. So now we're asking, well, where did that come from? Did it come from a legitimate source? Now, hopefully it did. Now, a lot of times people have money put in their shoebox, right? And it's somewhere in their house, but it's not in the bank. That is not seasoned money. We cannot use that money for the transaction. That's why it's really important to get a handle on their bank statements to see not only just deposits, but do they have the money necessary for all of it? Down payment, closing costs, and reserves, because reserves are important too. So when we look at it all, I want to make sure that all the money that's in the bank is something we can use. And if not, let's start talking about ways to bring in the money, maybe through a gift or something like that. But these are the reasons why we do the pre-approval process and not the pre-qualified process, because the pre-approval process allows us to ask these questions up front. So you're not under the gun during the actual escrow period and now trying to figure out how to solve an issue when you only have a few days because you're under contract and you have to meet that contingency deadline. So that's why it's really important to make sure they don't do a pre-qual, it gets moved to pre-approval. And bank statements are huge, especially on a purchase. All underwriters want to know, where is the money coming from in terms of down payment, closing costs, and reserves. Now, reserves are something that it varies on loan program. If you're just doing a basic conforming, whether it's normal conforming or high balance, reserves aren't really that drastic. It really depends on what DU tells us. And for you that don't know what DU, it's desktop underwrite. All files have to have this desktop underwrite. It's what we call DU, has to be in the file. Now, once we get that DU, it tells us exactly all the underwriting criteria that we have to address for the income. How many pay stubs? Do we need W-2s? Sometimes we don't need tax returns. Sometimes we do. The DU tells us if we have to have them in there or not. But it's also going to tell us how many months reserves we need. Maybe it's 1 month, maybe it's 3 months. So we look at the DU on conforming deals that tell us what it is. It's typically between 1 and 3. But once you get past that, once you get into jumbo loans, now all of a sudden it's a different ballgame. These jumbo investors are going to require reserves. And there's different tiered pricing based on reserves. So your best tiered priced lenders in the jumbo sector are going to require at least 12 months of reserves. And what is reserve? What's 1 month reserves? What is that? We look at PITI, which is principal, interest, tax, and insurance. That's 1 month. We're going to times that by 12. So if the total PITI is $6,000 a month, just take 6,000 times 12, that's 72 months. That's what you need in addition to down payment and closing cost. So it's really important. That number could be great if they're trying to get the best priced interest rate out there, because you're going to have to make sure that you have the 12 months reserves. And then it's important too, because some investors don't allow retirement accounts to be solely used for reserves. Sometimes it has to be 50% liquid funds, which would be money market account or other stocks and bonds they have, or savings, that sort of thing. But that's why we want to get the bank statements up front so that we can analyze them and make sure they have enough reserves based on the loan program that they're going for. So it's not something where, why do I have to give all this information to the lender up front? I'm not even sure if I want to buy right now. Well, the reason for that is because you want to prepare your buyers to be well educated in the process so they know exactly what they qualify for, but also to make sure that once you get into the transaction, you're not going to have any issues in terms of qualifying, that sort of thing. So it's all important. It's something that you should kind of push your clients to make sure that they give you the information, because it is truly something that all lenders are going to require. Underwriters, they're sitting in some room somewhere making a decision. It's all black and white. So the more information that we get up front from the clients allows us to write what we call letters of explanation for any issues that we see on the front end. And it makes your transaction process a lot smoother. The underwriters feel better because they get more of a clean package because we've already rooted out a lot of the issues, or it allows us loan officers, senior loan officers, to be able to sidestep some of the issues that may arise. So it's really important that we get all this documentation. Let's see. All right. So with all that, I know that I threw a lot of stuff at you guys. Hopefully you guys got it. If you guys need this screens on all of this stuff, just reach out to me, send me a text, and I'll get it off to you so you can have the entire presentation so you'll know exactly what we're looking for. Or if you have any other questions, you guys can reach out to me. My cell phone number is up on the screen as well. But some of the things that I'm going to be talking to your clients about, I talk about these to all my clients that are looking to get pre-approved, because a lot of times I'm dealing with a lot of first-time home buyers and they've never done this process before. So they really don't know, and they want us to hold their hands to kind of walk them through the whole process. So one of the first questions I'm going to ask them is, how much do they pay in rent? What's their comfort level as far as a mortgage payment? Because I want to make sure that I'm not just qualifying for the max, I'm qualifying them to where they want to be as well. Because the reality is there's probably some things that they pay for on a monthly basis that they still want to be able to do. Maybe their thing is that they like to travel, so they got to put money aside. And so that's got to be played into their qualifying, or at least to show them, hey, your max is, an $800,000 home, but your comfort level is 640. So we need to bridge the gap there somewhere, because where you really want to be is that $800,000 home, because that's where you're at. So let's talk about ways of making sure that you're comfortable with that mortgage payment. But we're also going to talk about the do's and don'ts. Like, it sounds really funny when we say this stuff, but it's true. I've had an issue almost with every one of these in escrow where someone opened up a new account. Now, it didn't hurt us qualifying. The person still qualified because it wasn't really that big of a debt. But what it did do was put us into a time crunch, because he opened an account at Mervyn's. Okay, great, no problem. Your DTI was pretty low. We can have that extra monthly payment. But the problem is I have to go prove what the balance is on that account, and it's too new. So the credit agency sees the inquiry. I have to go prove the account. It's still with Mervyn's and it's not even at the end servicer yet. So I can't even get the information on the account. You can see how that became a time issue. You do this in escrow and all of a sudden I can't get it cured because I can't get the information from the end servicing company that's going to handle that account for Mervyn's. So it's things like this. We just want to let people know, hey, I know you're about to buy a house. A lot of people are going to go to home furnishing places to start preparing for it, right? They're going to look at furniture, they're going to look at appliances, that sort of thing. And there's a great deal for that weekend. So I want to open up the account because, well, I'm going to get a 20% discount. So it really makes sense for me to do it right now. Well, I have to let them know, if you do that, this is the potential that will happen. You will have to show me what the balance is and prove that account, and that could be a time issue. So we really want to make sure that we're telling them not to open up any new accounts. Next thing is, don't transfer money around. Once you get into escrow, just leave it there. Let us verify it. I'll let you know when you need to transfer the money into escrow. It'll happen at the end of the transaction, but don't start pulling money into one account because it makes you feel better where it's all in one account so you can see it. Just leave it where it's at. Don't transfer it. Let us verify it. And then we'll start telling you when to transfer it at the appropriate time. Again, don't make any large deposits. We covered that earlier. Why? Because if it's over 50% of your monthly income, it could be an issue. In jumbo, just to aside of that, 50% was conforming. On jumbo loans, it's 25% of their monthly income. So that's why we have to know what type of program they're going into, look at their bank statements, making sure they're not making any large deposits. So we're telling them, if you're going to make a large deposit, it's coming in from a different source. Maybe we just bring it in the form of a gift. And that's very easy to do. All loan programs pretty much allow gift now. So we just kind of let them know the do's and don'ts there. Next thing is, don't pay off any debt unless instructed. And the reason for that is cash is king. Remember reserves? Like someone who has something and just wants to pay it off because they don't want that monthly obligation. I get it. Do it after the close of escrow. We need that extra $15,000, $25,000 that you paid off that car because you didn't want the car payment. I get that, but cash is king. We want it in there for reserves. It's working for the debt to income ratio. We can handle that car payment. We're going to go ahead and keep that and then go ahead and pay it off after the fact. The other thing is, it sounds funny, don't change employment status. W-2 self-employed is just almost the kiss of death. Because if you go from a salary W-2 employee to self-employed, we now have to wait 2 years before you can get a loan, at least a normal loan, full documentation, because self-employed borrowers require a 2-year history of that. I've had people who went from, it sounds funny, but they would go from an hourly wage to a monthly salary. that itself can create an issue too, because they were getting overtime. And all of a sudden they went to a management position where it's no overtime, it's just a base salary. It might be a little bit more than what their hourly was, and it gives them the potential to get bonuses down the line. So it's a better contract, better for them. But all that overtime they were making, and it could have been sizable, they lose it. Now all of a sudden from qualifying, I've lost that income, that overtime income. So that's why we want to have these conversations with them up front, just to let them know, don't change your employment status. I mean, I get it. You want to do it. Maybe you have to, and that's fine. If you have to, I get it. But these are the things that we want to talk about up front so that the borrower knows, if you do this, this could be an issue down the line. The next thing is, obviously, don't miss any monthly payments, right? All of a sudden they go on vacation, or they think everything's fine because you pulled a credit check and you were pre-approved, so they forget. It's just one of those things. Just make sure you keep making your monthly payment, because you do not want to have any negative item on your credit report, at least not now, because it's really going to affect your FICO score because of the recency of it. Next thing is, don't co-sign for anyone. Again, it's an added debt. I know someone else is paying for it, but I have to hit you for that debt if you co-sign for it. And then on top of that, the other thing is, remember, we wanted to have to verify the new debt. That could be a time issue as well. So these are some of the do's and don'ts that we're going to talk to the client with up front, just to let them know, don't do this. This is a conversation you can have with them too. Just take this sheet. And when you're in the car driving around, just say, hey, look, I know you got pre-approved. Just want to make sure. I know this sounds kind of redundant, but just don't open any new accounts. Make sure you make your monthly payment. Don't transfer the money around. If you have any questions about, the transfer of the monies or how to bring them in, call Chris. Let him take a look at it. Let him at least be advising you what you can and can't do so that you don't have any issues. Because again, once you get into escrow, you really have a short period of time to be able to close on time, right? Because you guys are writing 30-day close of escrows. Well, it sounds like a lot of days, but those are 30 calendar days. If you look at it, there's 4 weekends in there. So Saturday and Sunday's time 4, that's 8 days of non-work. So you really gave a lender 21, 22 days to close your file. So there's not a lot of time in there to cure any issue if they do one of these things. That's why it's important to get them pre-approved, have this conversation with the client up front, making sure they know the do's and don'ts of what to do. So hopefully you got that, and the clients won't do any of the don'ts. All right. Last thing. I wanted to give this to you guys as a tip, kind of a nugget. A lot of times people ask me, they'll call me up like, oh, the client only wants a $4,500 payment. Can you tell me what that loan amount is? It's a really easy calculation. Just remember 5, 6, 7. That's it, 5, 6, 7. So if you do it, and let's say the client wants a monthly payment of $4,500. Okay. You're trying to figure out, well, what will that buy that client, right? So you just take the $4,500 monthly payment that they want, divide that by 0.00567. As soon as you do that, that will give you the top end loan amount that they'll qualify. That's $793,650. They're going to put 20% down, so just divide it by 0.8, and that'll bring you up to probably about the $990 range. So they can look at $1 million home. Now, this is important to know, because if the client wants a $4,500 monthly payment and telling you, I'm not going to go any higher than $4,500, and they're looking at a $1.4 million property or properties, you're probably wasting your time, because they're not going to want that monthly payment, because I can tell you the payment's a lot higher than $4,500 what they wanted, because if you use this for a quick calculation, that the loan amount should be $793,650. Now they could still look at the 1.4, just means they're going to put $600,000 down as a down payment. If they've got that money in the bank, sure, absolutely, they can do it. Yeah, your payment should be roughly $4,500. It works the other way too. If you take, let's say $793,650 as a loan amount, and if you hit that and times it by 0.00567, it would also give you a number of $4,500. And then you would know what that's the monthly payment. Now, some things can vary. Obviously, if they're putting a larger down, the tax will be a little higher, so the payment can be a little higher. If they're putting less than 20% down, this won't totally work because now you've got mortgage insurance on top of that. But this is just designed to give you guys kind of a guide, basically. So when you're talking to a client, if he's telling you, hey, I want a $3,000 monthly payment, just hit it by that number, then I'll tell you where the loan amount is. You're like, okay, great. That's a $600,000 loan. Now you want to look at $1 million property, or do we have the $400,000 for the down payment, right? You don't want to get too in depth in the financing. I get it, but I think that you guys still need to have some sort of basic information to be able to tell the client what the do's and don'ts are, what the documentation is required, and why you're giving that documentation to the lender. And all the information that the lender is requiring is important. It's something that we do need. So that's the reason why we're asking for it. All right, so I'm going to go ahead and open it up to anyone who has any questions, anything like that. I didn't want to talk for the entire time, so I'm going to leave it up to you guys. If you have any questions, go ahead and put them into the chat screen. If not, it looks like
I put some questions on the chat.
there we go. I got into this is awesome information. Okay, we'll review it later. Does the calculation include property tax? If you're asking me about the tip, it does. That's the total PITI, the 567. That's everything included, but that's based on 20% down because there's no PMI in that. So if someone's looking to put less than 20% down, that factor is a little bit higher. You're probably more like 0.00600. Use that number because it's going to be higher because now you have to take into account the private mortgage insurance. Next question is, and at what interest rate? I use 3%. The market's been flat for the last few months, 3%. We're going to be in the low threes interest rate wise for the next, 6 to 9 months. I don't see that changing too much. So you'll be able to use this number. But this is really going to give you just kind of a ballpark. It's going to give you there. Okay. Are the refi guidelines different than a purchase? No, it's not. It's a full doc loan. We're going to ask for the same documentation. We're going to do the same screening. We're going to look at the bank statements. We're going to look at their pay stubs, W-2s, tax returns, that sort of thing, and they have to qualify. So it's the same documentation, actually a little bit more because we need a mortgage statement, proof of insurance as well, because they own a property now. So, the guidelines are the same, whether it's a refi or purchase, it doesn't matter. And the same, whether they're getting cash out on the refi or wait and term refi, it's the same documentation. FICO scores still play into the interest rate and that sort of thing as well. Okay. Can you explain what a DU shows? And do you have any resources that can show us how to read a DU? Okay. So DU stands for desktop underwrite. That's the Fannie Mae version of their automated approval. All files have to have this DU in the file. Now that's Fannie Mae. Freddie Mac does their own. It's called LP or loan prospect. But we have to have either one, DU or LP, and that tells us which direction to go. They're pretty much same underwriting guidelines. There's some little changes, sometimes just on student loans and how they calculate the monthly payment form. So that might, make us want to go Freddie Mac over Fannie Mae, that sort of thing. But going back to the DU, and the question is, can you explain what a DU shows? It shows everything. So basically our models, our application model is called Encompass. So basically we're going to input the application. It's also called the 1003. You may have heard that term, but we're going to input all the information into the 1003. And that's going to be the borrower information, right? Their income, their assets, as we got them from their pay stubs and their bank statements. We pulled a credit report. We merged everything together. So that file has everything. We verified all the income and assets, and the credit got pulled in. Now, what the DU does is when we send it off to Fannie Mae and they run it through their automated system, DU, we get then an answer back, approved, eligible. That's what you need. It's approved, and it's eligible for delivery to Fannie Mae. Now, on that, it's going to tell us everything. It's telling us income and what we need for the documentation for the income to prove what we put into the DU system. It tells us what we need for the asset, how many months bank statements, that sort of thing. It also tells us how many reserves we need. And what it did is it pulled all the information. It pulled the credit report from the credit agency into the DU. So it's all inclusive. It's all the information. And you just have to really read it line by line. It tells you exactly what you need to do. It's right there. And it breaks down every section, income, assets, that sort of thing. And let's see, and do you have any resources that can show us how to read it? Really, you call me. I guess I could be your resource. There's really no way of getting a DU because you have to be approved by Fannie Mae to have the access codes to be able to run the DU. But we can print them out and we can give them to clients. So if you wanted a resource, I guess me, you can give me a call. Okay, the next thing is, what is the rate for income property? Okay, good question, actually. So as I told you, there were hits, add-ons to pricing based on FICO score. But there's other reasons why you would have an add-on to your rate. It could be loan to value. If you're putting less than 20% down, you might have, actually you get a better rate. It's weird how it works, but you could. Or if you put more of it down, you get it down to 60%, you could have a better rate. So loan to value plays into it, but also type of occupancy. So if you go from owner occupied to non-owner occupied, you're going to have an occupancy or a non-owner occupied hit, which is 2.125, which typically means it's going to be about half higher in rate, everything being equal, same FICO, same income, same asset base. So the difference typically between owner and non-owner is 0.5 in rate typically. So the market right now is about 3.5, 3.6, depending on FICO score for an investment. And I'm not sure, it says, what is the logic behind that? If it's asking to, for the income property, it's because of the risk associated with it. So if that's the question, the logic behind the hit for non-owner, the reason for that is because the investor looks at it from a risk standpoint. So when a client gets in trouble and they have multiple properties, their own property, right? And then they bought a rental property, that's why they have non-owner occupied. So if they get into trouble, what's the first property they're going to let go? Probably the rental, right? Because they're not going to uproot their own family and they're going to hold on to it as long as they can. So that's the added layer of risk to the investor, is the client may default on that because of, if they ever get into trouble, that's going to be the first one that goes. So that's the logic behind why there's an add-on for the non-owner. Next thing is I have 450 cash owner. I'm not sure what that means. And then David said, yes, that is the question. So hopefully I answered that for you, David. All right, I think that's it. Oh, morning, Rosie. There's a question here, I think this is from Rosie. How do you advise them when they are self-employed and make, for example, $150,000, but declare only $50,000 in income taxes? Are the appraisals coming? Okay, so yeah, we see that a lot, right? Like they make good money, they're self-employed borrowers, they have good deposits, and you can see that their gross is $150,000, but they write off a lot because they don't want to pay taxes, right? So you really have to advise them, one, you either stop being aggressive with your write-offs and take a higher net income, which means you're going to pay more in taxes, but bring up that qualifying income. You could do that, but then there's tax implication. Second thing you'd want to look at is, can we get a co-signer possibly that'll help you come in? Because you can afford the monthly payment, you just don't show it on paper. So let's look at a co-signer potentially. And thirdly, I would be looking at down payment, for bank statement programs. That might be an issue too. The rates aren't that bad. They're probably in the low 4s right now. I've got a client right now who's willing to pay points, and he's in the mid 3s by paying 1 point. And he's only putting 20% down, and it's pure bank statement loan. I'm looking at the last 24 months of deposits. I'm going to average it, and then we're going to hit by a 50% expense factor, and that's his qualifying income. So maybe that might be a solution because yeah, you have a higher interest rate. Yes, your monthly payment's higher. I get that. But the payment's only $500 a month more, which is a lot, but that's only $6,000 for the year versus you go ahead and claim more income and you're going to have maybe $30,000, $40,000, $50,000 as a tax liability because now your taxable income is higher. So what would you rather have? Do you want to have the tax liability or do you want to have the monthly payment that's a little bit higher, right? So that's how I would advise someone who's self-employed. Just taking a look at their unique situation, cash flowing, and advising them some of the different issue or options they have. Okay, next question. Are the appraisals coming at price or lower in this current home purchase market? They're coming in at price and higher. I have not had an issue, knock on wood, in a while. It's just the market's been on fire. You know, we've seen 18+% in our market area appreciation year over year. We're hearing reports we're going to see double digits again, which is crazy year over year once we get into 2022. So the market is constantly pushing. You know, the ones that think that they're going to have an issue with the appraisal typically have no appraisal contingency in place anyway. So you probably don't have that issue, or you can have that issue because, well, it doesn't really matter. But normally on all my purchase right now, we have to get an appraisal anyway, whether you waived it or not, it doesn't matter. In the purchase contract, the lender still wants to make sure it's worth what you're paying for it. I haven't had any issues, not in a while, not in this market. Okay, how and for how long the forbearance is affecting seller who wants to buy a second home or refinance? So if they were just in forbearance, not foreclosure, but forbearance, it's not really affecting the seller at all. I mean, that because it's on the buyer side that they're getting a loan. So if that's the question, but I think they wanted to know the homeowner who wants to buy a second home or refinance. So let me tackle the first one, refinance. Typically they want to see, was there any modification? Was there some sort of resolution once you got out of forbearance? A lot of times they just kicked it onto the back end of the loan, and that's fine. And then they want to see history of at least 3 months. So you just have to make 3 monthly payments after you exited forbearance with whatever agreement you had with the lender, but you can refi. Absolutely. You just have to probably wait 3 months. And who wants to buy a second home? Same thing. They're going to want to see that you got out of forbearance and that you adhered to the program or the settlement. So if you said, hey, I'm going to make my payment plus maybe there was some other residual you had to make. If that's the agreement, the new lender is going to want to see that you've done that for the last 3 months as promised. But you can do it, definitely. Let's see. Oh, there's more questions coming in. All right, there's one more. All right. I think it's a long one. I think there's adding on to it, but this came from, for the rate on the income property, I have 450,000 cash down. Call me on that. I'm not really sure what you're after. All right, here's a question. A buyer that has less than 2 years of employment, can they buy a home or be used as a cosigner? Yes, depends on what type of employment they have. If they're self-employed, no. Because again, we need 2-year history and we're going to get a business license. I have to prove that you've been in business for 2 years. You can't just say it. We're going to want to see at least 2-year history of it. But if you're W-2, yeah, absolutely. That's fine. Now the rule is this. If you were unemployed for longer than 6 months, they're going to want you to be gainfully employed for 6 months before they use your income again. So it really depends on, you know, how long of a gap they had. Because I know the pandemic hit a lot of people and they had gaps, but they went back to work. And as long as they're back to work and they were just on furlough, you're fine. So it really depends on what type of employment. If they're W-2, yeah, they can be less than 2 years, that's fine. As long as they're full-time and permanent, because if they're part-time, that'll be an issue because a part-timer, we're going to want to see a 2-year history of being a part-timer. And so that can preclude them. But you can use them to buy a house or as a cosigner as well. Let's see. Is there an interest rate difference between second home versus income property? Yes, there is. There's a couple differences. So first thing, if it's an income property, you get the income of the other of the units or single family, whatever it is, but you get the income to help you offset the mortgage payment. So what I mean by that is if you're buying something as a non-owner occupied, let's say the principal interest payment just is $3,000 a month, right? That's PITI, but you're going to rent it out for $4,000 a month. Okay, we're going to give you 75% of the rental income. So 75% of the $4,000 is $3,000. That's a break even because the PIT is $3,000 a month and 75% of the rental income is $3,000. That's a break even. So that's why you'd want to go income property, right? Because it allows you to qualify for it because you get that rental income to help offset that $3,000 mortgage payment. Now, on a second home, that means you're not going to rent it, which means I don't get that rental income. So I have to hit you for that $3,000 mortgage payment. So now it's a qualifying issue. Will you qualify for that second home with no rental income? So if the answer is yes, then you're fine. And there is a difference in interest rate. So there's no that, remember we talked about the hit for the non-owner occupied, which was 2.125 in points, that's gone. So you're going to get a much better interest rate on the second home than you will with an investment loan. It's just that the qualifying is different. And again, that's something that you want to look up front, making sure they can qualify with that extra monthly payment and then advise the client of the differences. How does a student loan affect the loan approval? It does. It's a monthly payment. So even though the loans are in deferment right now, we still have to hit the file for a monthly payment. So what we're going to do is we're going to take the loan balance. Let's say that they owe $30,000 in student loans. And it's a combination of, let's say, 4 different accounts, right? Over the years that they had, but they all total 30 grand. We're going to hit it, even though it's in deferment, we're going to hit the file for 1% of whatever the balance is. So if it's a $30,000 balance, 1% is $300. That's the monthly obligation that we're going to put into the file. Just like if it's a car payment or credit card or whatever it is. Now, I told you there are differences between Fannie Mae and Freddie Mac. That's one of the differences. Fannie Mae goes 1%, Freddie Mac goes 0.5%. So if DTI is your issue and I'm hitting the file for $300 and I'm just getting over that 50 and I can't get it approved, well, then I'm going to go Freddie Mac because now I've got a $150 monthly payment and maybe my DTI drops below the threshold and I can get it approved. So those are the little things that we know. And we're looking at the file right up front and the client saying, hey, I don't have monthly payments and it's in forbearance or deferment or whatever it might be. Doesn't matter. We're going to look at the balance and it does affect your loan approval. Next one. Does this apply to someone who went back to work after being self-employed? I'm referring to the last question. Oh, okay. Back to less than 2 years. Yeah. If they were self-employed, they were gainfully employed. So if I can show tax returns that the guy was self-employed prior to, but then went on to a W-2, you're fine. There was no gap. It's really dependent on what did you do? Was it self-employed and you went to W-2? Now it's the same type of employment. Did you go from the same industry? Because a lot of times people were working as consultant based and then they went, got hired by that company and then they became W-2. Absolutely. I'm going to give you your full pop of that income. And you were self-employed. That's okay. That way is fine. Going from self-employed to W-2, there's no issue. It's the other way around. When you go W-2 to self-employed, you can potentially get yourself out of qualifying for a loan because we can't show the 2-year history. All right. I think we're down to the end. I think that's the last one. And there's one more question just came in. Oh, thank you for the presentation. Very informative. Thank you. I hope that you all share the same feeling. I just wanted to make sure that whatever I gave you was good and accurate information. Going back to the needs list, it is what it is, right? It's just, we need the documentation, but I would strongly suggest that you tell these clients pre-qualification means nothing. You need to get pre-approved because that's when they're going to uncover so many things because there's so many pitfalls. Everyone has their own unique situation It's just finding out what are the pitfalls and finding out what they are up front so that we can cure them. And that way you guys don't have any issues within the escrow period. And the anxiety that's there isn't from the loan side of it, because that's never fun. Anxiety is just over the what are they picking for furniture, the color and the carpet that they need to put into the new house. That's good anxiety. That's what they should have. All right. Well, guys, it is now 11:55. So I'm going to sign out unless anyone has any more questions. And you're welcome. There's a lot of thank yous that came in. You're more than welcome. I've been doing this for over 25 years now. Love to work with each and every one of you guys. If you guys have any clients that need to get pre-approved or just have questions, send them over to me. Love to help them out. I'm going to give them honest information. Whether I can do it or not, I think people need to have that accurate information. So, all right, guys, that is it. Other than that, peace out.
Thanks a lot, Chris. Appreciate you.
You got it.